and welcome to this week's episode of Coinscrum Markets. I'm Nisa Amoils. Coming up, I'll be joining Charlie McGarraugh from blockchain.com for his monthly macro view of the crypto markets. Teana is joined by Catherine Coley from Binance US. Philip Gradwell from Chainalysis reveals more insights this week. And we will talk DeFi with Lars Clausen from 1KX and James Brody from ID Theory. First, a look at this week's blockchain industry news. The world's largest digital currency investment trust, Grayscale, with a total of 2.2 billion AUM, this week reported that it's seen a tenfold annualized increase in weekly inflows to its Bitcoin fund, with an average of 29 million invested per week during Q1 versus 3.2 of last year. 88% of the inflows came from institutional investors, predominantly hedge funds. Facebook-led Libra will rebrand the wallet from Calibra to Novi. The wallet will operate as a standalone app, as well as provide interoperability with Facebook's social messaging apps, Messenger and WhatsApp, to make transactions as easy as sending a message. Novi customers will need to be verified using a government-issued ID. The wallet will initially be rolled out to a limited number of countries, although the release date still remains unclear. JP Morgan, providing further validation to the growth in institutional interest in Bitcoin, devoted 3 pages to Bitcoin in their regular global market strategy report this week. Topics in the report included the effect on hash rate and revenue for Bitcoin miners post-halving, open interest on CME futures and options, and the Bitcoin market price versus intrinsic value. The DTCC, which provides clearing and settlement, looks to adopt blockchain for optimizing public and private markets to strengthen post-trade processes and reduce risks and costs. 2 case studies, Project Ion for public and Project Whitney for private, will test the markets. Visa approved a DeFi crypto card in the UK by announcing their iDo card. This will allow 40 million Visa merchants to accept crypto-derived fiat currencies, including the British pound and euro. The company said that users have already pre-ordered 2,700 cards. Transactions signed from addresses claimed to be owned by Craig Wright following the unexpected movement of 50 early Bitcoins last week. The mystery deepened on Monday when it was noticed someone had signed transactions from 145 unspent addresses from 2009 that included a message, "Craig Wright is a fraud." The messages seems to have been referencing the fact that these addresses had previously been claimed during an ongoing court case by Craig Wright, the controversial computer scientist that outed himself as Satoshi Nakamoto back in 2016, casting further doubt over a debate that will no doubt continue for some time to come. Digital asset market data provider CryptoCompare was this week nominated for a Waters Technology Award in the Best Market Data Provider category, the only digital asset data provider nominated. We're speaking to CryptoCompare's CEO, Charles Hayter. Congratulations on the nomination, Charles.
Thank you. Means a lot to us and the team after 6 years of hard work.
So given that these awards are traditionally aimed at traditional finance, what is it that you've done compared to your competitors to have attracted the attention?
Well, I think there are 3 key things to being a data provider in the space. And the first one is scope of data that you provide. And we have about 270 different exchanges, as well as blockchain data and other sort of alternative data sets that really sort of make our offering quite complete. The other thing is our delivery methods. We have quite a robust API and WebSockets that we deliver the data through, and have about sort of about 800,000 unique users per hour on that. And we also have partnered with Refinitiv and BT Radians to utilize their networks to push our data out to users. We also have a number of indices that we produce on top of the data that give our data that extra push. So we kind of do what Refinitiv does and do what FTSE does as well at the same time. So
And how important are the data sources for the so-called institutionalization of crypto markets?
Data is incredibly important because the price mechanism is key. So the price mechanism is what people need to know about, and need to understand how that price mechanism is being created. And so trust in a data provider is probably the most important part of helping flesh out this industry and help it take it to the next step as we see more types of digital assets appear in the ecosystem.
Who are your typical customers?
So we have about 20,000 registered users of our API, and the free one we have about 800,000. And those are mostly just wallet users, etc. But on our key users of about 300 that we have paying customers, it's a broad church. We have the institutional sort of traders at one end of the spectrum. We have retail traders at the other end, but we also work with service providers such as the Big Four for accounting and audit purposes, tax purposes. We work with market makers. We work with, it's a broad panoply of anybody you can think of uses our data. And that's because it's trustworthy and reliable.
Well, great. Thank you so much, and congratulations again.
Thank you. Great to be on here.
That's the news for this week. Next up, I'll be speaking to Blockchain.com's Charlie McGarraugh to discuss the macro trends in the crypto markets in this week's Crypto RFQ. Hey, Charlie, what's happening in the markets this week?
Hey, Nisa. Well, it's been actually a little bit more chilled out and boring than usual, which I guess in itself is somewhat noteworthy. In terms of themes for this week, I guess, like one of the big stories is the lack of a story in the sense that volatility has come way down, and the market doesn't appear to be over levered. And we're kind of in the middle of the technical ranges, and it's more about kind of the bigger picture stories that are unfolding to see what people's conviction for the next step is going to look like. This first chart here just shows that basically volatility of Bitcoin is back to the kind of the bottom end of the sort of the baseline. So it's like fully business as usual in the market and without really anything out of the ordinary happening. This contrasts, greatly with the astronomical spike in short-term volatility in March, which you can see in the hump in the chart. And then, interestingly, we had a bit of an uptick through late April, early May, and the market's just come right back down again as it's just sort of not doing too much. If we go on to the next bit, the discussion with of Paul Tudor Jones about Bitcoin in the media has sort of got everybody excited about money printing and Bitcoin as a hard asset hedge, but it's really actually underperformed gold for most of the year. You can see in this chart that gold is in an uptrend, and Bitcoin is just sort of, albeit kind of all over the place earlier this year, it just hasn't really managed to put together a full uptrend post-halving. And recently, with gold coming down, Bitcoin has come down as well, signifying maybe a decline in popularity in that kind of hard asset narrative. You can see that really clearly on this next chart here, where you've got the open interest of Bitcoin futures on the CME against the Bitcoin price. And what you can see is we have this sort of astronomical build in open interest on the CME, sort of indicating that crossover buyers from traditional hedge fund world were potentially buying Bitcoin against crypto arbitrageurs with CME capabilities selling into it. And what's happened is that open interest is starting to tick down again, and that appears to be leading the price action in Bitcoin itself, as the sort of like we're going back to standard crypto market participants, basically like buying the asset back from the macro guys. Now, there's still a lot of ways to go. I'd say we're still in a longer term uptrend in this institutional, this proxy for crossover hedge fund buying. If it were to revert out, it would have to, delever a fair amount more, and would probably have a pretty negative impact on the Bitcoin price.
Do you think that the recent announcements, Libra 2.0 or the DCEP in China, or some of the tensions between the US and China have affected the price?
I think it's a great question, and the short answer is right now no, but I think it's one of the potential major catalysts looking forward. So Right now, I still think it's about money printing and kind of the demand for hard assets in the face of currency debasement, and the kind of like broader discussions about either the sort of like geopolitical importance of a DCEP, or re-envisaging, I guess, the way that we process payments and interact, commercially on the internet via Libra. I think those are still like, and whether or not that's an, on-ramp to Bitcoin and the crypto ecosystem, I think is still kind of not really the flavor du jour, unlike last summer. I think right now it's much more about how much more money is the Fed going to print, how bad can the economy get while the stock market, it threatens to take out new highs, and it's all about that money printing narrative. But I think Bitcoin, because of its failure to break 10K, has maybe gotten a little bit, boring as an implementation of that idea. The big levels to watch on the Fibonacci on the 1 year are 10,000-ish and 7,700-ish. And then other than that, there's basically no real breakdown. I would just point out one last thing in the market, which I do think is quite interesting, which is that Ethereum is outperforming Bitcoin recently. So it's suggesting that like the Bitcoin-led rally, which would kind of indicate new dollars coming into the space from crossover buyers, is kind of backing off, and now people are kind of monetizing profits in Bitcoin and buying the alts that they really believe in. And ETH seems to be one of those beneficiaries. So I think you're seeing some within the crypto community, some asset rotation out of Bitcoin and into other projects. That's it for me. Thank you.
Thanks so much, Charlie. The question of whether Bitcoin's power-intensive proof-of-work consensus mechanism will be sustainable in the long run is a debate that will no doubt rage on for some time. A number of more recent public blockchain projects have opted for the more energy efficient, though arguably less tested, proof-of-stake mechanism to underpin their networks instead. With the Ethereum network set to make the switch from proof-of-work to proof-of-stake later this year, Teana is joined this week by Catherine Coley, CEO at Binance US, to discuss what they're doing to help drive standards for this particular part of the industry.
Thanks, Nisa. I'm Teana Baker-Taylor, and I'm delighted to be joined today by Catherine Coley, CEO of Binance US. Hey, Catherine.
Hey, how are you doing?
I'm great. It's super awesome to have you with us today. Let's kick off with Binance US. So lots of people have heard of Binance, but tell us a little bit about Binance US. What's different? What's your value proposition? Tell us about what's new and exciting over there in America.
Yeah, so about a year ago, last summer, Binance US was started to be able to offer the same cutting edge technology that Binance offers the world to American users, specifically targeting a regulated, FinCEN regulated and approved platform to allow people to access, earn, trade digital assets in America. So
Awesome.
That's really where our team, Binance US, began. Being able to leverage the great technology of Binance, but customize it for an American audience.
Awesome. Great. A localized strategy.
Yeah, we're based out of San Francisco, but currently spread out all over the US.
Cool. Well, known for the decentralization of our teams, which I think is one of the real selling points of the firm. Lots of diversity.
Absolutely.
So last week, Binance US joined the Proof of Stake Alliance, which I think is really exciting. And there's a lot of self-governance initiatives around, but this one is really specific. So can you tell me a little bit about it and why you got involved?
Yeah, one of the things we saw, not only just allowing access to trading, allowing people to buy and sell cryptocurrencies, was the ability for folks to begin staking or having a say in the governance in order to earn staking rewards for certain coins. And so Binance US began staking for 3 coins, Algo, Atom, and Tezos. And one of the important things in order to be kind of continuing the health and development of staking industry was to take part in this Proof of Stake Alliance, which brings together the industry's kind of best and most innovative players from Bison Trails, Coinbase Custody, Tezos, Kava. You've got a good selection of folks that are going to be more mindful about how we go forward with A, regulation, or B, innovation around staking and where we can kind of bring this proof of stake forward.
Yeah, indeed. And so it is, it sounds like you're working toward a set of kind of governance best practices to kind of set the playing field for what good looks like in the staking environment. Does that sound accurate? And how does the consensus work around deciding what are those best practices? What do we need to work on to level the playing field?
Yeah, our primary mission at Proof of Stake Alliance is really to educate regulators as well as lawmakers to the benefit of proof of stake, a consensus mechanism that's more efficient, decentralized, and environmentally friendlier than proof of work.
Sure.
But that also means that the industry group has to begin addressing kind of the regulatory uncertainty that could limit its growth and the adoption of critical innovation, where we need to be able to move forward, especially as key players welcoming people into the staking industry. So that's really where we combine the membership, including lawyers, protocol development teams, kind of investment funds, as well as industry service providers like ourselves.
Okay.
So we're really working kind of hand in hand, especially with the federal regulators, and really hoping to continue to highlight the importance of using staking as a mechanism, but also just to ensure the security of various blockchains, as well as promote sound governance of these networks.
Absolutely. Okay, so I have some of the standards in front of me. Not that you would know them all by heart, but you know, they talk about refraining from investment advice, non-use of financial terminology, focus on security and participation, focus on access to the protocol, and not providing guarantees on amounts of rewards earned. So, you know, it feels a little bit too like it goes back to, you know, treating customers fairly and ensuring that we are clear about what the offer is, we describe it fairly, everyone has the same level of access, and if they don't, then what do they have? But I think the non-use or the use of non-financial terminology is a really important one, because I think oftentimes when we're trying to get people involved in the space, we can be really technical about things, whether it's the tech or whether it's the finance. And I know you're really focused on inclusion and getting more people involved in the space. So, you know, of that list that I kind of just read out, what are the tenets around what Proof of Stake Alliance is trying to do that specifically kind of resonates with you and your business?
Yeah, we absolutely want to strengthen that trust that people have in proof of stake ecosystem. So along the lines of not pursuing tricky terms or difficult jargon that's going to prevent people from really truly understanding what's happening is a huge component. I often stand by the motto of educate, don't intimidate. And oftentimes big words, or not even big words, but words that we've heard over and over in the financial system might not be totally aligned with how proof of stake works. So using things like dividend yield or interest payments, those are all things that connect to another type of you know, financial offering, but mislead people oftentimes when it comes to staking rewards.
Yeah.
So we really want to make sure that we're providing kind of a common language that people can use when they're discussing staking, so that we don't have you know, misalignment or misinterpretation of what staking actually provides. Which on the positive side of what staking really allows you to do, it allows you to have a say in kind of the governance or the access to it, or what does that mean from a standpoint of accessing staking rewards, really what's being provided for you. So that's where we're excited to be able to offer this to more people, especially our users of Binance US, and to allow for more coins that have proof of stake as their kind of consensus mechanism, be able to offer staking rewards to users through our platform.
Yeah. So staking rewards and proof of stake versus, you know, stacking sats and Bitcoin's proof of work, right? I don't like to identify with any kind of crypto camp, right? I'm pretty agnostic. You're pretty agnostic. I'm working for an exchange. You know, it's our role to be agnostic about technology, right? But what do you think the opportunities are for individual investors around that staking? Is it just to have a say, or what's the upside?
Yeah, a lot of that you kind of hit the nail on the head there. Whereas we can call it agnostic, but I'm definitely pro freedom of choice for our users. So giving them a full array of opportunity to get involved in whether it's proof of work, whether it's consensus algorithm, whether it's proof of stake, those are all, among a bunch of other varieties that we allow for the tokens that are listed, or the ways to which you can get involved in digital assets through our platform. But in terms of what are the advantages of people being able to stake within centralized marketplace, it allows them to be able to nimbly move between their strategies of investment that they choose in their own path. So I think that's one of the important things, is being able to provide alternatives that let people engage in a way that's both secure and convenient for them, and also do a lot of the hard work for them of calculating where their rewards are coming from, being able to distribute them, and kind of alerting you as well when the rewards are distributed. So that's really some of the ease to which our platform can be offering it. But the wonderful thing about proof of stake is that you don't have to be reliant on a Binance US in order to partake in that, and that's where we see plenty of groups as well, doing the staking on their own. Plenty of venture funds already heavily involved in the staking ecosystem, not needing to rely on one platform in order to allow that. We just simply include it in our selection of items that we offer, product features that we offer for folks to be able to do so nimbly between actively trading to actively earning.
Awesome. That's great. Proof of Stake Alliance is not the only industry body that you belong to. So I believe you also are a member of the Digital Chamber of Commerce.
Yes.
And so tell us a little bit about why you got involved with them, and is it still along the same lines of that education and growth?
Yeah, one of the steps we made coming into the US marketplace quite a many years after the first crypto marketplaces arrived in America, we wanted to make sure that we were still on that front foot of being able to promote the use and acceptance of digital assets, especially in the United States. There's a significant impact that Binance globally has had around the world, being able to offer access easier to folks, but especially in the United States, the focus on innovation and not being left behind is something that we care deeply about. And that's most of the reason of why we began the marketplace itself, was to be able to push and pursue those steps necessary in order to allow more Americans to access these global digital assets in a fair and regulated way. So our work with the Chamber of Digital Commerce, especially with Perry Ann and her team, is really to make sure that we're on that front foot, leading the way towards getting more Americans, larger groups of folks able to get access to this, these elements that, in my opinion, lead towards building your own financial confidence and giving you a sense of ownership going into the future of money.
Great. Well, I have one last question that's been on my mind the last couple of days. And I've been asked a lot, being, I suppose, a woman in crypto, and joining a large company that is an industry leader in the space. How do we get more women involved in crypto? And actually, in doing some research, I think it's a misnomer that there aren't a lot of women in crypto. There actually are, and those numbers are really growing. And just in our company alone, I think people would be really surprised to learn how many our senior leaders are women. Last question to you, Coley, how do we get more women either involved in the space and actively participating, or get the women that are actively participating to be more visible?
Yeah, it's funny. There was some tweet today that was highlighting something saying, there needs to be more women leaders. And I always scratch at that and say, like, aren't we just leaders? We're not just women.
Yeah,
leaders.
that's true.
Leaders.
Yeah.
But I also kind of believe in the school of thought of there's a lot to say it, but just do it. And so Binance has just done it. They've put women at the top of their business units, probably more than any company in finance I've seen. So leading the way by actually putting more people in leadership positions, offering those opportunities to more folks. I know our many of our Binance US teams meetings are almost 100% women when we're discussing product or operations, which is incredible. And you have to go, this is different, which is something exciting. And the opportunities in crypto especially are kind of quite unbounded. There's no reason to have a specific gender to lead ahead in digital assets when everything is open and available. It's really an equalized access that I think is super important. So seize the opportunity, ladies, to take something on. I wasn't in crypto 4 years ago. The last halving, I wasn't involved. So an opportunity like digital assets where you can apply your experience, continue to grow a team, build a fantastic product. Those are all things that are available to us. So what's holding you back? Just dive in. And interestingly enough, we've seen since the launch of Binance US in September 2019, a 42% increase in women actively trading in crypto.
Awesome.
Which is an unusual growth. And it has to, you have to connect the dots to see that perhaps seeing it is believing it. And that certainly helps. So the more women that are vocal about their involvement in digital assets or just pursuing different careers within it is really helpful to make people realize that the opportunities are all there and waiting for really anyone.
So great. I think you're absolutely right. I couldn't have said it better myself. So I think we've run out of time, unfortunately, but before we go, can you please tell our viewers how they can learn more about Binance US, Proof of Stake Alliance, and maybe get in touch with you directly?
Absolutely. Easiest way to get in touch with us is through Twitter. We're at Binance US, and myself is at CryptoColey, COLEY. And for learning more about Proof of Stake Alliance, please head to proofofstakealliance.org. And the Twitter for them is alliance_POS. We also have a blog piece written up about them on our website, binance.us. So underneath the Learn at the top of the menu, you can see our blog. So look forward to engaging with you guys there.
Cool. Great. Thank you so much for joining us today, Coley. It was great to see you.
Thank you. Have a great time on the other side of the pond.
Thanks. You too.
Thanks, Teana. Next, we go over to Philip for this week's on-chain reaction.
Thanks, Nisa, and welcome to On-Chain Reaction. I'm Philip Gradwell, the Chief Economist at Chainalysis, here to take you through what's been happening on the blockchain this week. To start with some context, the Bitcoin price has declined this week, is now fluctuating around $9,000. There was an interesting on-chain event this week where on the 20th of May, some Bitcoin that had not moved since February 2009 finally moved. And the market reacted with prices falling because people thought that Bitcoin belonged to Satoshi. Now, Satoshi owns between 1 and 2 million Bitcoin. So if Satoshi weren't to move their Bitcoin, that would have a big effect on the market. However, myself and many others suggest that it isn't Satoshi moving that Bitcoin. The blockchain analysis doesn't support that, but it still gave the market a shock. There's good reason for that. Old Bitcoin doesn't move that often. If we go back to 2018, we actually see that just 2.7% of all of the Bitcoin sent came from wallets that held the Bitcoin for more than a year. So most of the Bitcoin that's moving is actually younger than a year. So to see Bitcoin moving that's over 10 years old, well, that's a really exceptional event. But back to our core metrics. Looking here at the amount of Bitcoin flowing into exchanges, well, it looks like fewer people are selling. There's less Bitcoin coming into exchanges over the last couple of weeks than actually the 200-day average. So inflows into exchanges are really down. But despite these low inflows, the amount of Bitcoin that's being held in exchange balances, we actually think it's increasing. And that's going to increase the sell pressure because there's now more Bitcoin sitting on exchanges looking for buyers and not being bought and taken off. There is some uncertainty to that. If you look at the chart here, the solid blue line, that tells us about the change in balance that we know has happened. we know a certain amount of Bitcoin has come into an exchange, and we know a certain amount has left because it's already in the hands of other cryptocurrency businesses, other exchanges. Then this blue shaded area, that's Bitcoin that came into the exchange but has moved into an intermediate address. That can either be an internal address within the exchange, such as their cold wallet, but it could also be an individual holding the Bitcoin off the exchange, or indeed another exchange. So all of the Bitcoin that we think is internal is actually external. Well, then the change in balance is at the bottom of that shaded area. But even at that extreme assumption, if you're to look at the 14-day average, you would only see 1,000 Bitcoin coming off the balances of exchanges on average every day for the last 2 weeks. But actually, at the upper bound of that, we're seeing 19,000 Bitcoin coming onto the exchanges every day. So the majority of the weight of that shaded area is actually in positive territory, suggesting the balances have increased. In contrast with Tether, it's actually more likely that Tether on exchanges has been decreasing. You can see that because the majority of the shaded area is actually below the zero line in that 14-day average and in the recent week as well. And if Tether is actually being taken off exchanges, well, that's reducing the buy pressure on Bitcoin because people typically use Tether to buy Bitcoin. The flows between exchanges and Bitcoin are also down, particularly the flow of Bitcoin into the derivatives-only exchanges. And if we look about flows between regions, well, that's also down. And in particular, flows to North America have declined the most. This is reversing a trend that we've seen over the last few weeks, where actually the flows between both exchanges and between regions has been increasing. Now it's finally started decreasing. There's less Bitcoin flowing between different types of cryptocurrency businesses and between different parts of the world. So overall, while the Bitcoin price is high relative to much of the year to date, the on-chain signals are starting to look bearish. Bitcoin liquidity on exchanges is increasing, but the Tether liquidity is decreasing. So it looks like there are more Bitcoin looking to be sold, but not as much Tether there to buy it. Of course, Tether's not the only pair that Bitcoin is traded for, but I see it as a good signal to the overall health in the market. And on-chain flows, they've fallen sharply. There's not as much Bitcoin moving around. In particular, flows to North America have declined, which suggests that the opportunity to make some money in the North American market, which really is the second biggest Bitcoin market in the world, doesn't look so strong. So potentially a bearish outlook from here. And with that, it's back over to Nisa.
Thanks, Philip. Fascinating insights as always. As we have witnessed the crisis of trust in the traditional financial system, the ongoing dream of building a new decentralized financial system has spawned countless new projects and experiments. This week, we take the first of our monthly dives into the rapidly emerging sector known as DeFi, with Lars Clausen from 1KX and James Brody from ID Theory. Welcome to you both. Lasse, for our audience that does not know what DeFi is, can you explain it?
Decentralized finance, DeFi, really just means that it's financial networks and financial applications that could be so big or that are so big and so important that it's extremely important that they're very, very secure, that there's a sovereignty aspect to being part of that network. That network that I depend on can't just be taken away from me, that use. And then the third part is that it's impossible for someone to be the middleman, and the disintermediation is pretty much 100%.
Okay.
I think, Nisa, if I could, just to add to Lasse's description of DeFi, what we're seeing is the creation of a bunch of instruments that exist in the legacy financial system, but are being replicated here on chain. the great thing about this technology is that it's programmable. And so we're getting a lot of innovation that's not possible for a lot of the reasons that Lassie kind of touched on. You can remove the middlemen, you can get rid of fees, and you can have business models that were previously not possible.
So you're both investing in the space currently. What is your thesis?
So I'll start. I'm a geneticist by training, and our thesis draws a lot from biology. You know, you hear people talking about the DeFi ecosystem. And so you can look to even ecology actually to inform, or we do, to inform our investment management decisions. And what we see in this space are particular niches. So a niche, for anyone who doesn't know, is just the, you know, the functional position of a species within an ecological community. And I think, you know, blockchain technology has come along and created new niches. And we're seeing Darwinian mechanics at play. So, you know, it's a lot of survival of the fittest, natural selection, and it's not necessarily the strongest or the smartest or the fastest projects that are going to work or that will prevail, but those that are most adaptable and are most easily able to change. And this brings us on to kind of governance, and I'm happy to speak to governance a bit later, but our thesis really is that governance allows for this evolution and adaptability, and therefore the ability for these new money blockchain species to fill these new blockchain niches.
I love it. I never heard a geneticist define the space before, and it's fascinating to hear how you characterize it. So given the recent hacks or the stress test that happened Black Thursday, do you think that set the space back in terms of trust?
I think we've definitely seen a decrease in activity since, and so or for overall sort of DEX trading volume, volumes in general across the board are down a little bit. I think it's picking up again, but I think it definitely it was also, I would say, maybe before we had pretty uninformed optimism. You know, lots of people were not doing a lot of due diligence, throwing, you know, money into any protocol that had some yield. And turns out, you know, there are nuances to that. Some protocols are safer than others. And even something like Nexus Mutual isn't just a blanket, you know, you get paid when anything goes wrong. Yeah, so I think it definitely, it gave everyone a bit of pause. Volumes have been hit across the board, but they're coming back up now.
Yeah, and I just want to remark that, you know, we need events like Black Thursday to come around so that we can stress test the system, identify flaws in some of the protocols, and ultimately strengthen everything and the whole ecosystem, you know, and optimize what are very experimental technologies.
So to date, Ethereum with the smart contracts has been the leader in DeFi, and recently there have been more attempts to bring Bitcoin to Ethereum or WBTC. UMA is a project that's created the first synthetic token to track the relative value of ETH to BTC. What do you think of these initiatives?
So I think it shows that, you know, pretty much every other chain also is trying to connect to Ethereum, building bridges. You know, there's attempts now to bring Bitcoin to Ethereum, and, you know, Bitcoin has been around for a long time, but now all of a sudden it seems to be starting to take off. I think it really shows for the strength of the Ethereum sort of DeFi ecosystem. And I, you know, personally think it's great that we get many different forms of collateral into this sort of DeFi ecosystem. So I, you know, whether I have my maybe some reservations long-term about Bitcoin, I think in the, you know, for the next 5-10 years, I think it's fantastic to bring different forms of collateral onto Ethereum.
Right, and the technology that's being used works for Bitcoin, but it will work for other chains. So, you know, you'll have Zcash coming on into the DeFi space, which is great, because I think one of the flaws on DeFi at the moment is privacy. And, you know, so there are different examples as well for these different types of deploying Bitcoin onto the Ethereum chain, and some of them are centralized. Wrapped BTC is a centralized version. Some of them are decentralized. They each have their advantages and disadvantages. Again, it's coming back to this survival of the fittest. You know, it's great having all of these different options introduce themselves, and I think over time we'll see which of those is most suited to this use case. But you know, just to reiterate what Lassie said, it's very important to bring, you know, all of that economic value held within the Bitcoin network into or onto the Ethereum chain, and then be able to collateralize that value.
So looking at exchanges, Uniswap version 2, I think is the largest decentralized exchange on Ethereum mainnet, updated to increase profitability for liquidity providers. Do you think DEXs are going to look and feel a lot more like centralized exchanges, but that they will retain their non-custodial and censorship resistance?
James, you want to go ahead?
Yeah. So, you know, centralized exchanges are, to all intents and purposes, order book matching engines. I think the great thing about decentralized exchanges is we're seeing a lot of experimentation and new models. So you mentioned Uniswap. This is an automated market maker. It utilizes bonding curves to set the price rather than order book matching. I think, you know, the DEX ecosystem is going to be much more vibrant than the CEX ecosystem, and more innovative. And you know, if we can see appropriate incentive mechanisms that can build up the liquidity appropriately, then that's great. I think one of the problems at the moment is that we're still experimenting with what are the best ways to incentivize liquidity. And you know, the problem with DEXs is at the moment, they kind of fail around low liquid pairs. So that's certainly something that needs to be solved. We are seeing innovation from projects in the space like Loopring, who have incentivized market makers. They are utilizing zero knowledge proofs to reduce gas fees. You know, this is one of the problems. To be a market maker, you need to post orders, right? And it costs a transaction fee to get an order up onto the books. And then it costs another transaction fee to remove it. So you don't have the same flexibility you do have in centralized exchanges. DEX there's a different architecture. It's a different landscape. There are different niches. We're going to see different products and different solutions. And, you know, I think both will sit hand in hand together within the environment.
So I think we're already seeing some areas where decentralized exchanges are really blowing their sort of centralized versions out of the water. There was a few months ago already, just so someone did a video comparison. One window was Binance and the other one was trading on Kyber. And it would just, you know, Kyber, click buy, MetaMask confirm, done. And on Binance, you know, log in, 2FA, go to deposit, send the tokens there, wait a couple of minutes for the confirmations, go trade. Okay, then withdraw. 2FA, email confirmation, da da da. It took about, I think, 15 minutes in total versus Kyber like 20 seconds. And including the fees on Binance, actually got a way better price overall in Kyber. Coming back to also what James said, just the innovation that is happening in the centralized exchange space organically, there's no company that can ever compete with that. Employees get their salary, they might be somewhat motivated, but most of them, you cannot have these thousands of people that are highly intrinsically motivated, spending all their saved money to fly around the world to go to hackathons. And, you know, it's like the opposite of corporate. Like, they're not even getting paid, they're actually paying to do these things. And you can't compete with that. And the first examples is also these automated market makers that James mentioned. That is really a radical innovation, and it completely flips the model around where you don't have an order book anymore with always spreads, right? So there'll always be, on order books, you will always have a spread because market makers need to cover their costs and the risk, et cetera, what they're taking. And so you basically get down to almost essentially zero slippage, and anybody can become a market maker. Now, Uniswap, with a very generalized curve for everything, is hard, I think, to go beyond, you know, long tail tokens and buying $50 of them. We're seeing with Curve, for example, the first asset optimized market maker, automated market maker for stable assets, and it's just impossible to compete for Binance. Anybody else, no OTC desk, nobody can compete with Curve on swapping, you know, USDC versus Tether, for example. And so we're starting to see sort of specific, sort of, I would say, like asset specific exchanges that are just like vastly better than decentralized versions.
So what about any regulatory issues like KYC, AML?
Yeah, so I think there's always this looming thing like, okay, when do these standards that exist in the real world will be applied? And the simple answer for us is that actually it is vastly superior. Blockchains will enable KYC in a vastly superior way than we have right now. If you're sending a file of your scan of your passport and some you know, some like utility bill and sending that 50 times all over, it's just, if you know, you just know this is like way the past, right? So I think eventually they come down, depending on the country. You have a wallet, it is KYC, the utility bill is there. That adds whatever, an NFT or some other form of identity, and then the DEX sort of knows, okay, this is a KYC wallet, can trade here. This is sort of the Orwellian kind of like long-term option, but it would be vastly more efficient and possible with blockchains. I hope we don't have to go down that route. Maybe the KYC just stays on the fiat on-ramp and off-ramps. Until some point, there isn't really a distinction anymore between the fiat world and the crypto world, and it's actually all money, you know, real money, even in terms of regulator side. So I think those are the two scenarios I can see. On the other hand, also you have, you know, the Uniswap UI is on Arweave. That means it's there for the next 300 years, including hosting. So nobody can really stop this anymore. The smart contracts on Ethereum, you can't stop this either. So at some point, you also have to see as a regulator, as a country, like, unless you want to be China, you know, you're not going to be able to stop this. And the thing is, even if you're China, you can't really stop this anyways.
Right. Yeah, there aren't companies, there aren't individuals for the regulators to come after. These are deployed smart contracts. They, you know, if they're on Arweave, they're going to exist for all of our lives. And you have this almost, I guess, it's a kind of shared recognition by regulators now that there isn't much that they can do to stop these things. You know, there have been instances, I think Ether Delta, where there was an individual who they could target, but ultimately these are crypto networks, okay? They're global, they're open source, and they just can't be banned. So you've got almost like this game theoretic kind of viewpoint from the regulators, where it actually makes sense to embrace crypto, because if they ban it, people are just going to go elsewhere. And I think this happened with a lot of developers in New York or in the States when they introduced the BIT license. You know, other jurisdictions are going to compete for this business and for this innovation. And these are protocols, right? They can adapt and evolve around legislation far faster than this legislation can be written into law. So they're always going to be ahead of regulators. Regulation's good. We've seen lots of positive movements from the regulators in the US, the SEC, the CTFC in the UK, from the FCA in Germany, in South Korea. Ultimately, countries who have tried or who have had harsh regulatory stances have ultimately done a U-turn. You just have to look at China and India as a more recent example.
Mm-hmm. What about other issues beyond hacks, like network congestion or privacy or chain splits? Anything that you think about?
Well, so Ethereum, as far as I'm concerned, has really captured the DeFi space. I think, you know, the composability within means that any developer is going to develop on the Ethereum chain. There are issues with Ethereum that it could mean that it loses its crown. And I think one of the biggest threats at the moment is a contentious chain split. Because you have, in a lot of these DeFi protocols, you have individuals who are staking Ethereum or other types of collateral. If a chain splits and it's contentious and there are two forks of Ethereum, You then have these two DeFi protocols sitting on these two separate chains, but the value of the collateral could have halved or 40%, and it could have gone below a liquidation level, and you'd have a cascading liquidation event. So, you know, I think the fact that Ethereum is still forkable is an issue. It's where other chains that aren't forkable may prosper in this area, like Tezos. You also mentioned privacy. I think there are some very interesting innovations in the Ethereum space that are addressing this. You've got Ren, whose main net went live today, where, you know, in time you'll be able to wrap up Zcash, so you'll have exposure to the privacy pool there. You've got Tornado Cash, so these are mixers that also use zero-knowledge proofs to create the privacy. You've got other interesting projects like Aztec as well. So privacy is going to come, but, you know, at the moment it's not nice. You got to be careful with your addresses and what you do on those addresses, because anyone can trace back the ownership of your assets and what you've interacted with in the past. So I think privacy definitely needs to be improved here.
Well, great. Fascinating discussion. Thank you for joining us today. We look forward to talking to you again.
Thanks for having me.
Great. Thanks a lot.
You've been watching Coinscrum Markets. I'm Nisa Amoils. See you next week.